Please stand by. Good day and welcome to the HUD NSP Open Forum Question and Answer webinar. Today's webinar is being recorded. At this time, I would like to turn the conference over to Ms. Marsha Tonkovich, who will be moderating today's webinar. Please go ahead, ma'am.
Good afternoon, everybody. This is Marsha Tonkovich from ICF, and I'm sure I've met many of you as we've gone out and done NSP workshops and at the clinics and so forth. And we're happy to have you here joining us on what is one of a series of sessions on NSP Open Questions and Answers. Excuse me. So let me introduce my co-trainers and have them say a word about themselves first. So, David, if you could introduce yourself, and then Joan.
Hi, everyone. My name is David Noguera, and I am an NSP policy specialist here at HUD. Been working with the program since its inception and responding to questions and developing guidance as it arises.
Great. And Joan?
Joan, are you there?
Joan, you may have us muted. If not, Joan Morgan is here with us, and I'm sure she'll be joining back shortly. She is with the Relocation and Acquisition Division within HUD that deals with all of the tenant protections and the URA notices and the things related to URA. And we have had a large series of questions about those kinds of issues. And so we've asked Joan to join us today to be able to help you answer those kinds of questions. So we'll pull Joan in as we need to with those kinds of topics. So with that, let me let you guys know how this is going to work. This is one in a series, as I mentioned, of open question forums. So the intent here is to answer your specific questions and to give you a chance to talk directly to the folks at HUD and hear from them about policy interpretations or cases that you may be coming up against or any other questions you may have about the NSP program. So there's no set agenda. We're going to go through the questions as we need to. We have about an hour and a half or 2 hours for the call. We may get through it quickly, or we may need more time. So we'll play it by ear as you guys need. So in order to ask a question, we need to do a couple different things. First, we ask that you go up to the top right-hand corner if you're on live meeting, and you look at where there's a green dot there where it says feedback. If you pull down underneath feedback, you will see that there are other colored buttons, and one of those is purple, and that says Ask a Question. And so if you would like to ask a question, we ask that you first go into the feedback section on the top right-hand corner of your screen and turn the button on to purple. And then we ask that you press *1 to ask your question through the operator. And so what the operator will do is then take the questions in time order, so the first question, and then we'll just run through all of them in time order. And once you're done, we'll move on to the next person and so forth. If someone already answered your question, if you get in the queue and there's someone ahead of you who asks your same question, please press *2 to take yourself out of the telephone queue. And then finally, we ask that when your question has been answered, go ahead and change your status back to green so that we know that you're no longer in the queue for asking questions. So with that, we're going to start off today's presentation with a series of sort of common questions, and I'm going to actually hit a couple of these on this slide, but then there are some that we've had through the other webinars that have happened this week that I've asked David to do a little bit of a comment on because we've had some common questions related to it. So I'm going to start with the one on the purchase of appliances. We have had a whole series of questions about whether or not it is eligible to use NSP funds to pay for appliances, and if so, what types of appliances and which types are not allowed. So, David, if you can just hit a little bit on what kind of appliances can we pay for with NSP?
Right. So we recently published, I wouldn't say recently, I guess it's a few months ago now. We published some guidance on appliances that would be eligible purchases for NSP, and that guidance is available on the NSP Resource Exchange if you'd like to view it. But just to give you an idea, some of the things we're referring to here are washers, dryers, refrigerators, stoves, things of that nature. Basically, the major appliances that are needed in a home, and so long as they are part of a rehabilitation activity that's being taken place on the home, that's how they would be classified as eligible as rehab.
But, David, the kind of things that would not be eligible are sort of more mobile appliances, if you will, microwave.
A microwave, yeah, or I guess a blender.
Right.
What are some other big ones? I think we started allowing dishwashers, didn't we?
You did, yes.
Yes.
Window air conditioners have always been a question. Typically, they're not allowed because they're mobile.
Right. But the basic ones that are attached to the home and are considered a required appliance. So your refrigerator, stove,
washer, dryer,
dishwasher. Those are the main ones. But I do encourage you to look at the guidance for some other details. The big push is that they are Energy Star efficient, and the guidance will walk you through that. We certainly encourage them to be high efficiency appliances, but the minimum requirement is that they be Energy Star efficient.
Okay. Another one that we've had that was a common question that is in the new FAQs has to do with habitat, that if I'm a grantee and I am contracting with a habitat to do construction work, and assuming that I've contracted with that habitat as a developer, and we'll come back and talk about whether the habitat is a subrecipient, but if the habitat is being contracted with as a developer and they are doing their own in-house contracting, in other words, they don't typically hire a general contractor, but rather they are the general contractor, if you will, as habitat, the question then came up, how do I obligate those funds?
Right. So if you're working with Habitat and Habitat is your developer, then once Habitat has identified an address and has provided a detailed cost estimate of the rehabilitation expenses that they expect to incur on the property, then those expenses can be considered an obligation.
So the Habitat would need to have some sort of work write-up or cost estimate of what's going to be done to property A versus property B and so forth. And then once that is incorporated within the contract with the Habitat, you can then count those as obligated. You don't have to have external contracts with the plumber or something to cover sort of the volunteer labor, as long as you've got that cost estimate.
Those extra layers of information are what we require for the grantee or the subrecipient. But for the developers, that wouldn't be the case.
So, David, let's clarify for folks. There are people across the country who have called their habitats subrecipients as opposed to developers. And so if that is the nature of the contract that you've executed with your habitat, and yet your habitat is probably doing what habitats normally do, which is construction of units or rehabilitation of units, you probably want to go back and take a look at changing the nature of that contract and changing it from a subrecipient relationship to a developer relationship, because if you call them a subrecipient, then you do have to have those external third-party contracts with the plumber, with the electrician, with the drywaller, some of which is going to be volunteer labor and so difficult to document. It would be much easier for you to go back and amend the contract to call them a developer. So
the other thing I would add is that in some cases you may be using Habitat to develop public facilities as well as housing. In those cases, what you want to have are two separate contracts, one which would identify Habitat as the developer and one which would identify Habitat as the subrecipient.
When they're doing the public facility.
Right. So based on the scope of work that you're hiring Habitat to take on, you want to make sure that the contracts are appropriate for that scope of work.
Okay, and one more common question, guys, that came up this week that I wanted to share with all of you and then ask David to answer, and then we'll move on to that. We have some questions in the queue. So we had a lot of discussion on some of the earlier webinars this week about the concept of when you are doing the development assistance with NSP, so you're paying for the acquisition and the construction or the rehabilitation, particularly in the cases where you're paying for 100% of the total development cost with NSP. And then what you're going to do is sell off that unit to an individual home buyer. We've had a series of questions about, well, can I then close out the construction? I'm going to get the program income back from the construction when I sell the house, but then could I do a separate draw out of locks, out of the DRGR system, in order to be able to pay for the down payment and the closing costs and the soft second loan and whatever else for the home buyer as a separate transaction from the construction transaction? So, David, if you could talk about that a little bit.
Right. So we often speak to home ownership assistance from a blanket perspective, right? And I think it's important to identify exactly what type of homeownership assistance that you're referring to. Because in some cases, when you, the grantee, or you, the subrecipient, have acquired the property, rehabbed the property, if you're looking to provide homeownership assistance, some types of homeownership assistance would be considered what we call a principal buy-down, right? In which case, since you own the property, then you can dictate the terms at which that property is being sold. I may still be speaking in vague terms, but let me just give you an example to try to clarify that. So, for example, you acquired the property for $50,000. You rehabilitate it for $50,000. You've now drawn down $100,000 from your NSP line of credit. You'd like to provide a second mortgage to the income-eligible home buyer to the tune of $20,000, right? You would not be able to draw down an additional $20,000 to pay for that second mortgage. Since you own the property, that second mortgage would come in the form of a reduction in sale proceeds that you as the grantee would receive. So rather than you receiving back $100,000, if the property is being sold for $100,000, what you'll receive back is $80,000, and that $20,000 would come as something like a seller's credit at closing, you would manage it that way. Now, I do want to make sure I differentiate the different types of homeownership assistance, because in some cases we're looking at a principal buy-down where you would not be able to draw down additional funds from your line of credit, and in some cases it's considered an increase in the total investment. So, for example, if we're talking about subsidizing the interest rate, well, that's an increase in total investment. If you're talking about providing a second mortgage, that's a principal buy-down, so you wouldn't be able to bring it out. Paying upfront property mortgage premiums, that's an additional investment. And down payment assistance, I already said, I didn't say that yet, but down payment assistance was considered a principal buy-down. And finally, closing cost, that's considered an increase in total investment. We have a Q&A up on the NSP Resource Exchange. It's currently listed under the eligible use scenarios, and it has a table on there. It's called Direct Homeownership Assistance Table, which gives you the information I just went through. So you could please refer to that.
Terrific. All right, well, with that, just to get us rolling, why don't we go ahead and get started on some of our questions. So, again, let me just leave on the screen the way to ask a question. You're going to turn your dot from green to purple in your upper right-hand corner under feedback, and then you're going to press *1 in order to get into the conference line. So with that, David, our operator, if you could go ahead and give us our first question.
Our first question comes from Joshua Burton with North Carolina Department of Commerce.
Yes, I actually have a handful of questions. One came up from that last explanation on second mortgages. Mm-hmm. The assumption in that second mortgage scenario is that the NSP subrecipient grantee is actually the one that's holding the title or deed to the property, and so buying down the actual cost of the property, eliminating that and saying that's you're double dipping, I understand.
Right. Okay.
The situation we have is we have a number of programs where we are but a small portion of the cost of the property, and we're incentivizing the purchase of foreclosed properties in specific communities, mm-hmm. where it may be more to the tune of $15,000, and it's leveraging either other state programs or third-party financing for the remainder of the indebtedness on the structure. And so in those situations, we've pretty much said it looks like based on the current interpretation of obligation, the programs have to die before the obligation date. Like there's no way to continue cycling that program. Mm-hmm. And I guess based on what you said, it still sounds like that's true. For our grantees that are buying the properties themselves, managing the rehab, and then essentially flipping and reselling those, we know they can actually reduce the principal amount owed or recapture the equity in the form of a second mortgage. Is there any scenario where somebody could continue a first-time homebuyer program past the obligation date where they don't know the address or the buyer?
They don't know the address or the buyer?
Right. They continue to offer it for the life of the NSP program.
Yeah. So have you seen the obligation guidance that we released?
I have, and
okay.
my interpretation of that is there's no feasible way to do that. But I just wanted to pose the question in case there was something I was missing.
Okay,
It's the address that's the key part here, which is you do have to know the addresses by September, by the obligation deadline. You don't actually have to know the individual household.
So if we were sponsoring a program like that with Habitat for Humanity, could the Habitats, if they knew the addresses in advance, could we obligate first-time home buyer discounts through one of our other partners with, it wouldn't be a Habitat that's a subrecipient, but a Habitat that we're just supporting? Would it be possible if we knew the addresses to obligate the dollars to those structures?
The problem is because you're the grantee, just knowing the address isn't good enough. If you were the developer and you had a contract with a grantee, just knowing the address is good. But as a grantee, you'd need, at a minimum, a contingent sales agreement.
Okay. So, but let's say these Habitats have the properties in hand already. Let's say they've got 10 addresses. And we're going to put in could we put in an agreement with them for the down payment assistance for the 10 properties, even though we don't know who's going to be, we're not actually structuring the soft second at this moment.
How would Habitat acquire the property? With NSP funds?
Let's say it's not NSP funds. It's vacant structures that the city is donating to them.
Oh,
something of that nature, vacant lots.
Then sure.
And they're going to address it under redevelopment.
Yes.
So they're getting sponsorship dollars, but we're just doing part of the permanent financing in the form of a soft second.
Yes.
Could we obligate those dollars with a contract in advance, like we would for, say, if we were sponsoring? At this point, we've been telling everybody if we do that, we have to sponsor the actual construction, and we're providing like a construction bridge to Habitat. But we have sort of thrown the soft second thing out the door. We've toyed with the idea of transferables, where we're awarding Habitat a transferable second mortgage that they could transfer to the buyer, but it sure would be a lot simpler if we could just put an agreement together and then create create the soft seconds later on when the homes are ready to be sold.
Right.
Let me recap. I think I understand your question. So if you are not using Habitat to do the construction, but rather you're going to run the soft seconds or the down payment assistance, whatever it is, through them, if they are doing the construction and you know those addresses and they're under contract for those addresses, could you obligate the amount that the soft, you could estimate that the soft second write down on each unit will be $50,000, let's say.
Right. It's usually less than that. It's usually 15 or 20, but yeah.
So 20, let's say. So could you obligate that $20,000 even though you're not paying for the construction, obligate the $20,000 without knowing that it's going to Mrs. Jones or Mr. Smith? And
exactly.
So it seems to me,
without knowing the beneficiary.
Right. And so David, it seems to me that as long as they know the amount, in other words, they know that the write-down will be $20,000 or $15,000 or whatever the number is, and they have a contract with Habitat or whoever is going to do that write-down and they've identified the site, it probably doesn't matter that it's Mrs. Jones or Mr. Smith because we know the write-down will be $20,000.
I think you still have to look at it from the standpoint of a contract.
Right.
Right. And
so
we would
if
still
your contract is with
the difference between a contract and a mortgage.
Right.
We could put a contract together between us and Habitat, or between, in this case, one of our cities that it is actually the grantee, and Habitat, and accomplish that if we could put together an agreement or a contract with them. It just is a lot more complicated if we have to have it in the form of a mortgage that could go to that beneficiary at the date of obligation.
Right. What I would consider is, well, number one, as a developer, the developer can be considered a beneficiary, much like the income-eligible home buyer, right? So you can call it a mortgage. You can call it loan financing. You can call it whatever you want, but the contract or the agreement is with Habitat in this case. Now, you can have, as part of that agreement, that those funds that you are providing to them when a home buyer is identified will then be passed on to the income-eligible home buyer. But it's not enough to just say these funds are being put up for person X, right? It has to be an executed agreement.
If it's an agreement that says $20,000 for 101 Jones Street and 121 Main Street, and it's got the address and the amount set aside.
What's the eligible activity?
It would probably be redevelopment.
Okay, so then,
it's direct homeownership assistance under redevelopment.
It's right. Homeownership assistance.
So there's no home buyer identified yet to deed, but what there is a contract with Habitat to provide the direct homeownership assistance.
Yeah.
So
Have you seen that one yet?
We know the address. We know the amount. We just don't know that it's going to go to Bob or Susan or Betty.
Right. That's the missing piece right now. And so I've got a couple cities that are looking. They would like to sponsor some of their habitats that they historically have a good relationship with, and would use NSP dollars to do so, but they don't want to jump into an agreement to create something that ultimately won't count for obligation.
Yeah, I don't think I can give you a definitive answer right now, because I'm thinking no, but there may be something that I'm missing. So
I've been chewing on that one. It seems like it's an interpretation answer, but it really is based. I know you guys got to look at consistency across the board.
Yeah.
Providing an interpretation.
So what I think would help to get you an answer to this, if you could go ahead and put it into the Ask a Question.
Sure.
We ICF have been skimming them as well as our colleagues at other providers. I'll watch for it and get that into David and John quickly, and they can try to get you guys an answer. I think it hinges on whether or not having a contract with the Habitat and specifying the address without the beneficiary being known. If we know the amount, and that's the key thing, you should have to specify what the amount of the write-down would be or the mortgage or whatever. That would
it's usually fairly standard. They'll sponsor 15 or 20, and they'll know that in advance, but they just won't know the beneficiary. Usually Habitat knows their beneficiaries pretty early, but in this case, they have the lots. They don't have the beneficiaries already identified.
Yeah, so write it up and send it in, and for everybody else who's listening who may have this is a very common question. I've actually gotten the same question twice now this week. Watch the FAQs because there's a new version of the FAQs that's actually live as of yesterday. So watch for it. Once we answer it directly to North Carolina, then you'll see it come up on the FAQs. So I think you said you had one more question?
I have a few, but I'll try to keep them short. On the webinar on Monday, and again today, you mentioned 4 nonprofits that use the term identifying properties as part of obligation with the work write-up. What does identify mean? Does that mean they have site control if they're like a nonprofit developer, or does that mean that they have identified a property they plan on pursuing? What falls into that word identifying?
What is the context?
You had mentioned earlier, even in this call, you said as a developer to obligate, if like say for Habitat for Humanity, if they are not as a subrecipient but they're a developer, to obligate it, you mentioned that they have to identify an address and do a cost estimate or a work write-up. And I'm assuming, does identify an address, does that assume that they have site control, purchase contracts?
Okay. So it means that in DRGR, the address, you would have an address identified, and in your records, whatever hard records or electronic records you maintain, there is an address, 123 Elm Street, whatever it is.
But David, you guys also did say on Monday that in order to, and I think we went back and checked, it's actually in one of the notices way back when you guys described who was a developer, you did say that in order to be considered a developer, their role in the sort of process, if you will, as part of the undertaking the activity, they do have to have site control.
Okay. Well, that's the definition of here's the difference, right? On one hand, because I don't want to mix up apples with oranges. On one hand, we're talking about obligations, right? And what is an obligation? Well, it's when you make a commitment, and we're saying if it's the grantee obligating to the developer, then what we're looking for in that agreement is an address and a scope of work, right? If we're questioning whether this entity that you're obligating funds to is a developer, or maybe it's just really a contractor, then the way you differentiate a developer from a contractor is one that has both site control and is doing redevelopment on the property.
Right.
Okay. Okay. So in some cases, Habitat would fall into both of those if they're both the GC and they are the one that's managing the project.
Right.
Okay. One other, land banking. For the purpose of land banking, and I tried looking at the FAQs, it sort of approaches it like to do land banking, you have to be a land trust or like a recognized land bank. It doesn't, I never actually saw that in writing, and so my question is, could any of our grantees engage in the activity of land banking, assuming that the property was eligible and they don't know what they're going to do with the site, but they commit to addressing it for NSP beneficiaries within the 10 years? Can they land bank, or do they have to be incorporated like a trust or some other organization? Like, could a Habitat for Humanity or a city that doesn't have a land bank that under their current structure, could they engage in the activity of land banking?
If you look at the definition under the October 6, 2008 Federal Register notice, you'll see that it says a land bank is a governmental or non-governmental nonprofit entity established to assemble temporary management and dispose of vacant land. So you actually have to go through a process of establishing a land bank in order to act in this role.
Yeah, I read that. I just didn't understand where to take that. I didn't know if being recognized as a grantee was sufficient to be established as one because they were given the funds to potentially land bank. Okay, that helps.
So if you don't mind, if we please feel free to come back in because we have a number of folks who are waiting to ask questions. So do you mind if we move on and then jump back in with another question later on?
I got one brief one I can say and then hang up.
Okay, that'd be great.
Obligating housing counseling dollars. Do we have to know the beneficiaries' addresses, or can a contract with the provider accomplish that?
Right.
So you're going to sign a contract with the provider that's going to be providing housing counseling?
Mm-hmm. So it really it depends on how their contract is designed, right? Are they being paid by the hour? Are they being paid by the number of individuals that they're counseling?
Typically what I'm finding is they're paid to offer the service for a length of time.
Right.
They don't always know if the people coming into the service are going to buy an NSP home or another home.
Right.
So you only know like way down the line, like a year down the line, that person may have been an NSP beneficiary.
Right. So in the cases where you have identified the address, the individual, then that housing counseling would be an activity delivery cost under acquisition. In the cases where you have not, or you have a failed acquisition, maybe the person decided not to buy, it wasn't the right timing for them, then you just have a public service.
Okay. Right. I think that's it. Thank you.
Thank you. Okay, let's move on, David, our operator, to our next call, please.
Thank you. Jesse Garcia with the City of Phoenix. Your line is open.
Hi, Jesse.
Good afternoon. This is actually Joe Belval. Jesse signed in for us.
Oh, hi, Joe.
Good afternoon. I'm back to the same scenario. I apologize, but it does tie into obligations. So we're doing acquisition, rehab, resale. We got a developer, an actual developer by all definitions. And if I'll just toss out a defined term, if we can call it net funding, the home buyer assistance, if you will reduce the amount owing to us from the developer when we make them an acquisition loan and a rehab loan, and we go to liquidate at the home buyer's escrow. We'll reduce the amount owing to us from the developer by the amount sufficient to cover the buyer assistance we intend to provide. Right? That's kind of how you've...
That's correct.
That's
right,
the net,
right.
And if I may, I'll call that net funding, just to avoid repeating all that stuff.
Okay.
For the sake of projecting our obligation, we think it's prudent to anticipate that over the development period, so the developer acquires the property and 3 or 4 months later, under the nightmare scenario, 6 months later, they're now selling it for less than originally projected.
Right.
And potentially they could have to sell it for a price so low that we will have an insufficient ability to write down any further. We might, so if we want to provide $15,000 in homebuyer assistance to a home buyer, maybe our ability to write down is only down to $12,500. We might have to pay a small amount in actually to accomplish it. There's just insufficient funds in the escrow.
If you have acquired the property, right, and rehabbed it, I don't see, and now you're selling it. Whether you let's say you're in the property for $100,000. Whether you sell it for $100,000 or you sell it for $1, I'm not seeing where the additional money comes in, unless you're trying to sell it for more.
No, actually, the scenario that I'm painting may involve more a scenario where one of our developers has got a line of credit from a bank,
right?
And those folks are going to insist on getting liquidated in cash. They're not going to write down nothing. And so I hope I can send you a spreadsheet where I've modeled this.
I see. So,
but in the meantime, just indulge me and say that let's say there might be a horrible economic scenario where we can't write down any further and we may need to actually pay something in. And actually, as a sidebar, we were wondering, in terms of paying the developer their developer fee, would you prefer that we try and net fund that also? In other words, let them take their fee in the form of a reduction in the amount that they owe us on their acquisition and rehab loans.
Well, the developer's fee isn't a principal buy-down. The developer's fee is an additional cost, right?
Yes.
That'll be added to your expenses.
That's the way we've seen it, but I was just...
I don't think you'd net out the developer fee because it's like any other construction cost. So,
yeah.
So you'd add that in, but I do think what the scenario they're setting out to be is one where there's not 100% construction financing, where instead of if the total development cost is $100,000, they haven't paid all $100,000 with NSP. They've only paid $15,000.
Then you have no problem drawing down additional money.
Okay, and that's where I'm finally getting to my question, and that is in order to meet the obligation requirement, we're now, let me back it up several months to where our developer has entered into a purchase contract for the acquisition of the property.
Yeah.
So we have that identified. They've given us the documentation sufficient to support their scope of work. Essentially, we're going to get from them a pro forma. May we show in that at that time, can we project that we might have to pay some portion of that instead of taking a net funding approach where there's insufficient cash? May we project in that we're going to have to pay that and therefore obligate it at the time of acquisition of the property?
No, because you don't know who you're going to be selling it to. You don't know what the market conditions will be when you're selling it.
That's exactly right. So how can we then set aside funds to be able to pay in?
Provide homeownership
we can't
assistance.
Obligate it.
You're saying to pay for homeownership assistance?
Yeah. If we're going to provide $15,000, and as Joan has said, maybe there's insufficient write-down available at the back end, so we have to actually pay some small part of it in to make the HUD 1 balance. The only way for us to obligate that is if we obligate it because by the time this transaction actually closes out, as with a lot of people, I'm sure, our acquisitions are outpacing our rehab and resale. And so a lot of the rehab and resale is going to take place after the obligation deadline. We won't know until that home buyer escrow is ready to close whether we're actually going to have to pay cash in.
Yeah, so this really becomes a program design issue, all right? You're going to have to, consider some different models. I know what we've told folks in the past is if you use your allocation to deal with acquisition and rely on program income to deal with the homeownership assistance because you don't have the home buyers lined up yet, you could try something like that. I've seen in some of these buyer-driven models where commitment letters are given to individual home buyers, and that's considered the obligation, even though they haven't identified the home yet. I don't have an easy answer for you, but you're going to have to look at just how you're going to pay for it, how you're going to account for the various expenditures that are going to rise throughout the project.
Yeah, I think, to be honest with you, program income is the only answer. Yeah. Because, as you said, you will have done 100% obligation of your grant funds basically on the construction and acquisition and whatnot side, and you haven't yet identified the home buyers, which might be 6, 8, 10 months down the road. At that point, you're going to look at the income coming off of those acquisitions and those sales to fund the down payment or the closing cost or whatever you're doing for the home buyers.
Okay. I'm very grateful. I had no expectation of easy answers, but I very much appreciate your work on this and these webinars. Thank you.
Thank you for joining us. Okay, David, our next caller.
So we're not going to net fund.
Next dialer is Frank Ramsey with Collier County. Your line is open.
Thank you. I just have a question regarding interagency payments. We're a local county government, and we have used our real property management department to handle the researching of properties to acquire, then negotiating the contracts and handling the closings. They also have a staff appraiser, and so they are billing us $350 for each appraisal, and then the $65 an hour documented by timesheets for their services in identifying and buying the properties. Is that an eligible project delivery or admin expense under NSP? And if so, is there a CFR or an FAQ reference you could point me to?
So who is the entity that is billing you for the time?
It's
the subrecipient?
It's an interagency department within the county government.
So it's part of the grantee, David. It's a different agency within the grantee.
Yes,
okay,
I'm sorry.
But the agency within the grantee is the one performing the appraisals?
Correct.
Okay, so then it is a project delivery cost.
Mm-hmm.
Right.
Yeah, as long as they keep the timesheets, they do have to back up for you that they appraised X number of NSP homes at Y number of addresses, and they give you the backup documentation that then backs up what they bill you.
Yeah, and the activity is just acquisition.
It's just acquisition rehab, and they're only involved in the acquisition side, and we have all timesheets and invoices.
Yeah. Yes.
The problem I'm having is with our finance department is struggling to find something in writing that authorizes these kinds of payments for services. Is there a CFR or FAQ or something in the NOFA or any kind of reference to this as being an eligible use of funds that you're aware of?
Paying for appraisals?
It's paying the interagent.
I just finished writing a memo for King County, Washington. It hasn't. I think it's going to be signed and released soon, but it's not quite there yet. That's the closest thing that resembles what you're referring to.
Okay.
If you send in a question online, I could probably provide it with you.
Thank you very much. I appreciate your time and all your efforts.
Thank you. Okay. David, our next caller, please.
Next, we'll go to John Carter with City of Taylor, Michigan.
Hello.
Hi, John.
A couple of quick related questions. First question, when can we consider funds obligated to LH25? When a home is purchased that we are going to use, that we are going to rehab and use for the LH25 set aside, or when there's actually a family identified?
So this one is somewhat. You've got some flexibility here, right?
Okay.
Because any property that you acquire could potentially be used to satisfy the 25% set aside.
Correct.
Right? At the obligation stage, we're just looking to see, okay, what properties are you targeting? What address, what properties, what expenditures are you targeting for the set aside? Right? That may change as the program plays out. But the bigger issue is come March 2013, we're going to be looking to see, okay, what properties did you actually use to serve LH25?
Okay.
So you don't have to have the houses completed, constructed, and occupied by September.
Right.
You simply have to have identified that property or that funding or whatever, that subrecipient, let's say, is only doing LH25 activities. You have to have some way of having obligated it for that purpose, but you don't yet have to have the occupants in place.
That exactly answers my question.
Yeah.
A related question, actually two related questions with the same nature. We have, through our municipality, we have some subsidiaries that are nonprofit entities, housing authority type entities. One was created as Taylor Cares. It was where we purchased some homes from HUD. We purchased a bulk of homes from HUD maybe 6 months to a year prior to NSP coming along. And those homes were to be the same, pretty much the same type thing. We purchased them for $1. We were supposed to renovate them and sell them to income-eligible buyers. Can we use the NSP funds to purchase some of those homes from that subsidiary?
You already purchased them, you said, some dollar homes?
They were purchased, back in 2008.
Right. So you could certainly use NSP. Are they vacant?
They are still vacant.
Right. So you could certainly use them under eligible use E, but they wouldn't count as abandoned or foreclosed.
Okay, because they are owned by the city.
Because they weren't abandoned or foreclosed when they came into the NSP program.
Okay.
Yeah.
They were abandoned and foreclosed when we acquired them.
Right. But they weren't purchased with the intent to use NSP funds on them.
You're correct. Okay. And then the other question would be, with a similar subsidiary LLC housing authority, could we, for the LH25 set-aside, could we purchase and rehab properties and put them in their care to be used, to be occupied by low-income families?
Yeah, they would just be the operator, right? It's just like a subrecipient operating.
They would manage
rental
the property, or possibly create a land contract type agreement or whatever, but they could be used as that facilitator?
Sure. I think if you're now, where I'm wondering if you're going, are you trying to use NSP funds to pay for operations or just for the AC rehab?
We would simply pay for the purchase and rehab, and then donate that property to these entities.
That's fine.
For either possibly a rental scenario, or maybe they would act as the land contract holder. If we have trouble funding with the families becoming funded.
Yeah, but I caution you again. We're going to be looking. Did they actually benefit that population at the end of the day?
Yeah, that would be. I mean, ultimately, they'll put low-income families in the properties.
Right.
But the question being, if we have some challenges in getting those low-income individuals qualified to purchase.
Right. Then you might rent. Yeah, and you have the flexibility to do that.
Yeah, as long as at the end of the day you can prove that 25% of your money went to benefiting low mod, it doesn't really matter, or the up to 50% of median. It doesn't really matter whether it's rental or homeowner, or whether you swap it out later down the road. As long as whatever mix you have, you've got 25% of the money going in that direction.
Yeah.
Fantastic. Thank you very much.
Great. Okay, let's move on to our next caller, please.
Are those all subject to target areas?
Oh, I'm sorry?
Yeah. Yes.
Thank you.
We'll go next to Jennifer Olson with the state of Montana.
Hi, Jennifer. It's Marcia. How are you?
Just fine. How are you, Marcia?
Great.
Thanks for taking my call. I have actually two questions. One's really quick. We are, it's actually about the same property. We have acquired a foreclosed piece of development property. The developer walked away. So one building is actually existing, and it's occupied. The next part of it is a 2 acres of vacant. It was actually part of one contiguous piece of property. The developer actually did not get to the rest of the property. So we're putting on a new high-density 36-unit condo building, which will be for sale. The individual condo units will be for sale to homeowners. And my first question is, can we, and I think we've talked a little bit about this, and maybe I'm just not paying attention as closely as I should or not missing it, but we would like to pre-purchase the units. And previously, maybe back in October, I'd sent an FAQ and asked if we could pre-sell or pre-purchase those units without them being built or anything like that. And I believe the answer was no. We didn't have a contract or anything like that with them. So the reason that the question has come up is simply because of I believe it's the FHA number of units right now. There can be at least 50% of those units could be qualified for FHA financing, and I think that in 2011 that's going to be reduced to 30%. So what we want to do is with those 36 units is start to pre-sell them to qualified individual home buyers. So right now we just got the bids in to begin construction. Construction isn't planned to be completed until after the beginning of.
Do you have lot numbers? Have the lots been identified yet?
We have an entire we have a plot, and we have an entire architectural plans, so we know units and we know designs of units. We just have the contractor that's going to probably begin work in July. So that's kind of where we are. So I suppose we could push the developer to establish addresses per se.
Are there other funds that you're relying on to make this project possible?
NSP is building the building. We're basically the bricks and mortar behind it, and then the financing for the individual homeowners is coming from from all different sources of financing. For instance, FHA financing for those units.
So the commitment that you're trying to make is not a commitment to the builder or the general contractor. It's to homeownership assistance?
Exactly. They would like to pre-sell them, and where NSP funds are involved is we potentially could be doing, basically soft seconds or even DPAs to reduce the cost of the units to help people that are 50% AMI get in there, in which case what we've been doing is not necessarily obligating those direct funds. They've been coming out as program income. So we really don't count it as our 25%. However, there's an indirect way that it's affecting NSP funds.
But, Jennifer, you're paying for 100% of the construction costs with NSP, right?
You got it.
So you've got the same issue that David talked about earlier, which is if you're paying for 100% of the construction costs with NSP and then trying to do a soft second for the home buyer to make it affordable to them, you've already put, let's say the TDC on each unit, the total development cost of each unit is, let's pick a new number, let's call it $200,000. And you've put all $200,000 in for the acquisition, the rehab, the construction, whatever. And then you want to take a soft second back. What the point David was making earlier was you wouldn't draw down new NSP money. There's no additional obligation you would make. Rather, you would obligate the $200,000 that you did for the construction,
right?
And then you would take a soft second off that.
Exactly, and that's really not my question. My question really is, can we pre-qualify those individuals without actually having? I mean, it's really being built from the ground up.
Well, since it's not additional money that you're drawing down from your NSP line of credit, I don't even think that's necessary at this point. If you just focus on the money that's being used to build the homes, then that'll be your obligation.
Right, and I feel comfortable that we've met it through our obligation, and maybe I'm not making myself clear. So I'm not concerned about, because right now we have a contract with a GC for around $3.25 million to build these 36 condo units.
Right.
So then we've essentially obligated it for the contracting, or for the construction.
Right.
My thought is the developer, which actually is a nonprofit acting as a developer, they are wanting to start to pre-qualify and sign contracts with individual homeowners to get them into the house so that they can get their FHA financing. And then as we provide those if we're writing down basically some of the costs, it really is coming out of program income. We're not going to be drawing.
So that's not an obligation issue.
It's not an obligation issue. It really is just can we do that? Can we pre-qualify people?
You can certainly do that, and by the time you actually use your program income to fund that, it will be an eligible activity.
Okay.
Because it's home ownership assistance.
It's really a program design issue for you guys because it's not a matter of drawing down additional money at this point. It's a matter of at what point do you want to line up the home buyers. So if as a program design you decide that you want to line them up now, knowing that there's not yet a building, I think that's fine. I think the only risk of that is what if the developer doesn't follow through and doesn't finish the building. So, and obviously you'll have to have contracts that deal with that issue, but presuming you've dealt with that as a program risk, there's no NSP reason why you couldn't do what you want to do.
Okay, and really it's coming from the FHA lending perspective, too, if they're comfortable with that, I would imagine. And so my second question is, in the same, actually our bids came in way low, probably mostly because of the economy, and so we've got a little extra funds that we had potentially set aside for them, and they would like to put in playground equipment on this property to make it more sellable. Is that an eligible NSP expense?
Yes.
Oh, it is. Oh, okay.
Yeah, it's an area benefit. It would have to. The area would have to. You'd have to qualify the area as being LMMA.
Okay.
Low mod, medium income area. But yes, those would be eligible.
Yes, it would depend. It would probably depend on whether the playground equipment is sort of just for the kids who are at the housing development. It's like in the middle of a courtyard or something in the development, or if it's something that the neighborhood kids are going to use, it's more like a little mini park. Then how you set it up will probably depend on the nature of that playground.
Okay.
Right. So it's not a state park. It's not a city park. It's a playground that caters to those income eligible residents in that area.
Okay. Yep. And we can definitely talk about that. Right now, we kind of shied away from it, just because it seemed.
That would be fine.
Yeah, because CDBG allows for public facilities, it allows for those kinds of things.
Yeah.
Right, but it wouldn't count. It definitely wouldn't count towards our 25%.
No.
Yeah, that's what and that's one of the reasons we're kind of leaning away from it. Just simply because we want every nickel and dime we can to help us count towards that 25%. So, all right. Well, that's all my questions. Thank you. Thank you so much.
But hold on a second, though. To the extent that the project overall is a 25%, like let's say you were doing a multifamily complex that just happened to have a playground on it. I don't see why the whole cost wouldn't be part of it.
That's what I was saying, David. It depends on whether it's part of the complex or whether it's sort of a neighborhood park that's adjacent to the complex. If it's a part of the total development cost of the complex, in other words, it's like I said, it's in the it's in a courtyard in the middle of the complex, and the only kids who are going to play on it are the people in the complex.
Right.
Then it's a line item within the complex's total development cost,
right.
And I think therefore that cost would in fact count for the 25%. But if it's, let's say, an adjacent lot or some edge of the property where you're going to build a little mini park, then I would set that up as a public facility under eligible use E, and that would be an area benefit activity, and then it would not count.
Right.
Okay. Because right now when we're our design did not include that. It really isn't adjacent or part of a park, city park, or anything like that. This development is actually just on the outside of the city limits in the county, but it's in Bozeman, so it's growing there. So it's right almost, I don't want to say isolated, but actually the neighboring property is actually an easement. So there would be no building there. It would actually only be accessible. But the design of it doesn't actually put it in the center of it. It actually puts it almost
so it's
in
a separate project.
Yeah, but it's still.
Yeah. So then it would be a public facility. Okay, just wanted to make sure about that.
This same project, though, we're going to be looking to make sure that these 36 units meet 25% of them. Basically looking at their dollars, that it meets the 25% requirement, that at least, 25% of the dollars that are going into it are available for people that are 50% AMI. Right. And we've designed it from the get-go.
Okay. Great.
All right.
One thing I wanted to remind folks before we go on is that we do have Joan Morgan online, who is our relocation director. And to the extent that we have questions that may be coming up on the URA or voluntary acquisitions or tenant protections or anything, we would like to utilize her for those.
And we do, David, we do have one that's been written in text.
Okay.
But Adam also has his hand up, so when we get to Adam Blake, he has a URA question. So I don't know what order you are in the queue, Adam, but we'll get to you.
Okay. If we could go to the URA question, I'd appreciate that.
Okay. So David,
Joan, are you there?
Yeah, I'm here.
Okay, great.
David, our operator, can you go ahead and open up the line for Adam Blake, please?
Yes, Adam Blake with County Court. Your line is open.
Hi, thank you all. I appreciate it. The question has come up many times as we acquire properties through banks and, frankly, buying HUD-owned properties. We submit the URA addendum with the contract and also the certificate of notice placement. The URA addendum doesn't need to be signed and returned. You're simply proving that you've presented that information to the buyer. The certificate of notice placement does need to be signed and returned, and to document that the seller a tenant has not been living in the property or is not living in the property. We can't get either documents. We can't get acknowledgement that either document has been even received from HUD as a seller, from Fannie Mae as a seller, from Freddie Mac as a seller, from any lender as a seller, because no one will sign the documents. So I do my best to document that I'm sending them, but I have no documentation that they've been received or even acknowledged.
Well, in terms of the notice, the Uniform Act notice, you need to present it to the owner either personally or mail it, and we have said send it, return receipt requested. You can't force them to sign the return receipt.
Right.
This day and age, the post office does a lot of things online and automatic, and it may show it's been delivered, and you can print that off from online, so that's sufficient. Okay. We do not require that there be a certification that the property is vacant. Determining whether the property is vacant or has been occupied or had a tenant is a responsibility of the grantee. You can ask the seller to give you whatever certification or verification they can or are willing to, but if they are not willing to sign anything, give you any information or whatever, our guidance does talk about what you can do in terms of due diligence to assure yourself that there isn't an obligation to pay relocation to someone.
Okay. And can you point me in the direction of that, where I can find that through the HUD website, because I haven't been able to find that?
There was a guidance piece put out on
Is it on the Resource Exchange?
It is, yeah.
Okay.
If you go up on the NSPTA website or the NSP Resource Exchange, and you search on, I believe it's under Other Federal.
Okay.
You'll see it. It's a guidance piece on relocation acquisition. I believe it is also on HUD's website. So if you go to CPD, so go to HUD and then go to the programs part under CPD, and then you'll see there's a section on acquisition relocation. I believe it's also up there.
Back real quick on the URA piece. So I did develop a process where I can pretty much prove that I've tried to send it, and that is via the return receipt. But we didn't do that initially. To cover our rear ends moving forward on the properties that we acquired while we were trying to find our legs in getting the proper documentation that we had been presenting the URA. Do you have any suggestions?
Documentation that you sent the letter?
Yeah.
Do you have a dated letter in your file?
I have a dated letter in my file. I have the email where the package was sent to the seller, but my discomfort is in the fact that no seller to date, and we've purchased 30 properties with NSP, has acknowledged receipt. All I have is documentation that I've sent it.
Well, that's sufficient.
Okay.
I mean,
wonderful.
You are required to notify them. You can ask them to send you a return receipt, but there's no requirement that they return a receipt to you.
Exactly.
Yeah.
Okay.
You've done what you can. You know, people will do what they're going to do.
Right, right.
As long as you have evidence that you took the steps that were necessary, that's as far as you can go. You can't move their hand on the page.
Thank you very much. I appreciate your time.
Okay.
All right, that's great. So let's move on to our next caller, please, David.
Our next question comes from Glendora Merchant with City of Deerfield Beach.
Great. Can you hear us?
Glendora, your line is open.
Hello?
Yep, we can hear you now.
Okay, thank you. I'm sorry, I had it on mute. I have a couple of questions, and one of my questions, I think we already drained that one, so I'm not going to go there again. But this is regarding the financial assistance. Anyway, my other question is, because I'm trying to find ways to make that work if we can, count the money, is that if we get our closing agent, our title company / closing agent, to give us a projection of closing costs, would that be sufficient documentation to obligate those closing costs that we would be able to pay for the 25% set aside?
You would still need to identify the buyer that's going to receive that those closing costs.
Oh, so we have to have a contract with the buyer to obligate the closing costs?
Right. Well, yeah. That's how we define an obligation. It's a contract between the grantee and a third party.
Right, but because we can't. Well, the thing is, because we cannot count the financial assistance in the obligation is going in as part of the acquisition rehab, then we didn't, have a buyer, a particular buyer. We just know that.
Yeah, you haven't identified the buyer yet.
We have the property, but we haven't identified the buyer yet.
Right. So that's a program design issue.
Okay.
Right, and you may have to use program income to provide that those closing costs.
Okay.
But from an obligation perspective, it's not enough to say, hey, we're going to use this money as closing costs. You have to say who's going to receive that.
Even if we were to get a HUD, it's not a HUD statement for a closing, but at least the title company will give us one with all the costs that's related to each particular property based on a scenario for a low-income buyer.
Yeah.
Still can't use that.
No, I mean, if you were working with a developer,
mm-hmm.
and this was part of your agreement with the developer,
mm-hmm.
you could probably do it that way.
Mm-hmm.
But you and then the developer would count as your third party.
Mm-hmm.
But if it's just you and person X that you haven't identified yet,
mm-hmm.
then you don't have a contract.
Oh, okay.
Yeah.
Now, my next question is, we have a property. We already rehabbed it. This is just a, what-if scenario. We already rehabbed it, and we getting ready to sell it. Total acquisition and rehab cost is $120,000. However, because of the market in the area, it's not appraising for any more than, let's just say, $100,000.
Right.
The borrower for this property, they got a first mortgage of, let's just say, $30,000, and so we have to meet them halfway, or more than halfway, but we have to meet them with a balance,
mm-hmm.
which would be, in essence, because the bank won't let them, get it for pay more than it's worth.
Right.
So now we have
$7,000. So then the cap on what you can sell it to them for is the appraised value,
right?
Even though you have more than the appraised value in it.
Yeah.
Those are just considered sunk costs.
So what do we do with that cost?
Which cost?
The difference
the difference?
Yeah.
It's just a sunk cost.
Okay. So
it's just an investment in the unit. It's called a development subsidy. It's not a problem.
Okay. Now, next question. If we go ahead and we obligate our funds and it comes back that for some reason costs came in less than what we obligated, and we're way past the obligation deadline, what happens in that scenario? How does HUD view that as far as the grantee not meeting the obligation? And this, again, is for the 25%.
I think the first step now is getting to September, right? In terms of how we deal with contracts that may fall out after September, we haven't provided you with the guidance yet.
Okay.
That's coming, but we're not there yet.
Okay, and then reduced cost, I'm just trying to verify some information I got through an email. If we sold the property at reduced cost, again, that's considered a sunk cost,
right?
And not necessarily anything that we need to obligate here or there.
Right.
You've already obligated the full amount of the total development cost that you put in, and it is totally fine. If you sell it for less than your cost, in fact, there are many instances in which if you're dealing with very low-income families, you want to sell it for less than your cost.
Right, okay.
There's no problem with that. You just invest that as a development subsidy in the deal, and it stays in the deal as part of what you needed to do in order to bring it up to code or whatever you did with the rehab. And assuming the rehab was reasonable, you're all set.
Oh, okay. All right, thank you.
All right, so David, let's go on to our next caller, please.
Next, we'll go to Darlene Rich with St. Louis County.
Hello.
Hi, Darlene.
How are you?
Good.
Good. I have a question. It's regarding the I'm sorry. It's regarding the section of how we do I'm sorry. I got distracted here for a second. We have an issue with program delivery, and I wanted to make sure that I'm putting it in DRGR correctly. The issue that we have is that we have our staff that's acting as inspectors on the properties to make sure that the properties are meeting the code and following all of our standards. We don't own any of the property on our own. We have developers that are rehabbing the properties for us. How do we report in DRGR the expense that we have, the timesheets that we have for our staff time as program delivery? Should I add that to the individual, say, developers' activities in DRGR, or can I set up a separate activity that says program delivery and here's the amount?
Okay, I'm not a DRGR person. Have you? I don't. Are you, Marcia?
Only a little bit. There is actually an FAQ on this.
Yeah. Have you tried the DRGR helpline yet?
No, I didn't think to call it DRGR. I was just asking you guys.
Sorry.
I believe there are two. This is not a fact. I would verify this with the DRGR folks, but I believe you can actually do it either way. To the extent that you can, is the timesheets that they have given you have unit addresses on them so that you can allocate that cost across the various addresses that you've set up in DRGR, then I believe you could do it that way. However, if they don't, or it's you will have some that are going to they're going to inspect and then they'll never go to fruition, they'll never become a project. I believe that what they've said is in DRGR when you set up the activity, which is home buyer assistance or whatever the broader activity is that you're doing, that you can put the program delivery costs under the activity rather than under the specific unit address. So I think you can do it either way, but I would verify that with the DRGR people. Does that sound right to you, David?
Yeah.
And I just call the DRGR hotline?
Yeah, I would call the DRGR hotline and just verify that to be sure.
Okay. I have another question, if I could. The subrecipient agreement that we have with our housing authority who is maintaining our land bank, it outlines the things that they're going to be doing for us, like maintaining the property, holding insurance and whatever. They're also going to be demolishing some of these properties for us. When I was at a conference or at NSP training in Chicago, we met with one of the little roundtable discussions, and the contractor or the consultant there said that we needed to have separate agreements, not just a subrecipient agreement, with our land bank to carry out these activities. Is that something that still you think we need, or
you're saying you want the subrecipient to buy property to land bank?
Yes.
Okay, so do you have an established land bank, and is this subrecipient the one that manages it?
It's our housing authority, and they have within their ability to hold property. Is that enough? You know, I mean, it's within their authority to hold property. Is that enough? It's not a
temporary manage and dispose of vacant land for the that should do it.
Okay.
But I wasn't sure what the advice you got was, but it is important that you guys, as the grantee, you do need to have an NSP contract with the housing authority to undertake the land bank. You don't need it for each individual property or each time they go to acquire something or all the different things they might do for you under that contract. You just need one contract, but you do need to have one contract between the grantee and the housing authority.
Yeah, and we have that under our subrecipient agreement.
Yeah, so that should do it.
Oh, okay.
Right. And in that it says that it will be land banking. It'll be acquiring property for the purpose of land banking?
Yes.
Yeah, okay.
Okay. All right, then. I think that's it, then. Thank you very much.
Thank you. All right, so let's go, David, let's go on to our next caller, please.
Next, we'll go to Stephanie Boucher with Hand.
Hi, Stephanie.
Hi. I had just one quick question. We are a developer, and there has been some confusion on what constitutes a documented cost estimate. It says that we need
for rehab?
For obligation, probably.
Yeah, we know what we need to do for the acquisition, but that we are a developer and we have control over the property, but it says that we're supposed to furnish a documented cost estimate. So I want to know what constitutes a documented cost estimate.
Yeah, I'm not a developer, so I can't tell you exactly what should be in it, but it's typically the various costs that you expect to incur through the rehabilitation process, and to the extent possible, you want to break it out in detail. Marsha, I don't know what you.
Yeah, what it needs to be is a line item cost estimate, right? So
yeah, line item cost.
Yeah, so you can't just say, rehab is about $100,000. You need to be able to show that, this much for the roof and this much for the plumbing and this much for the drywall and whatever else, and break it out. And that breakout should be based upon your architect or your inspector or your engineer or whomever is dictating what the scope of the rehab should be.
And can demonstrate that they are based on the market rate for those types of expenses.
Right. So you can't just make up a number. You can't use, Marshall and Swift or one of those cost estimating books or something like that. You actually have to have a real idea of what the rehab at this particular property or the construction cost of this property is going to be. So often we see there's an official FHA form that's used often for multifamily properties, and there's a separate one for single family that lays out all the various line items and all the various costs. Something like that is what you're looking for.
So a signed or stamped cost estimate from an architect or a stamped cost estimate from an engineer would qualify as a documented cost estimate.
As long as it has all the detail that goes behind it. So I don't think it wouldn't be sufficient for the architect to hand you something that says, I think it's going to cost $100,000. That would have to be backed up by the detail of how they got to that number.
Okay, so it's more important about showing the line items. It's
not
really important about who has it, who does it. It's that there's the line items are shown.
And that it's real. In other words, that it's not a fictional number that somebody made up who's not an inspector or who's not an expert at this. It was made up by someone, whether it's the construction contractor or the architect or the inspector or whomever, but somebody with a knowledge of how much this rehab ought to cost.
Okay.
Right. And you as a developer might have that knowledge.
Right.
Okay.
Yeah.
All right. Thank you.
Mm-hmm.
Great. Okay, our next caller, please.
We'll go next to Tatiana Escobar with City of Miami Gardens.
Hi, Tatiana.
Hello. Could you hear me?
We can.
Okay, perfect. I have a question because I was hearing the answer that you gave regarding the obligation of the closing costs before, and it got me really confused. On Friday when we had the first webinar, or the first that I attended. I'm sorry, last Thursday, yes. Right. This is the answer that I got, and I wrote it in an email to my boss, very excited, because it says that we can obligate closing costs as disposition costs correlated, that is a correlated expense. Once we have a contract with the general contractor, we do not need to have an actual buyer for the property yet. And that's the answer that I think that it was, I don't remember who gave me the answer, but that was the answer that I received on Thursday. And today you're saying that you need to have a buyer in place. So which one is the final?
So
I think maybe the distinction, David, is whether there's a developer involved.
No, this is us grantees selling directly the property to the buyers. And when I told them about my case, is basically the city is selling directly the properties. At this point, we have homes and we have potential buyers. We haven't matched them yet. We have 7 properties under contract, so those are easy. But for the other 30 properties that we have that do not have a buyer set up yet, I told them, how can we obligate the cost for the closing costs? And that was their answer. They can be obligated as disposition cost. Yes. And that's why you got me really confused, and I have to ask you.
Homeownership assistance is usually done as the activity. It's usually done. Excuse me. Closing costs is done under is usually done under the activity of homeownership assistance.
Yes.
To do homeownership assistance under closing costs, under disposition.
That's what they told me. It's a correlated expense. Because the final use for us is to actually, transfer the property to eligible buyers.
Right.
But we need to obligate them, because that is for sure that we're not going to have buyers for every property that we have at this point.
Right. The problem is you don't have a contract with anyone for those closing costs.
Definitely no, but one thing that we know for sure is that's why they attach it to the contract with the general contractor, because we said, and that's what they told me, once you have the sales price, meaning the purchase price plus whatever you're going to spend on rehab, so that's why the contract with the general contractor, you can actually apply the percentage that you're going to apply that is the general use in your area. It can be a made-up number. You have to be able to prove that that's the percentage in your area. So let's say in this area it's 7% based on our other programs. Mm-hmm. So I can apply a 7% for each amount that it would be the sales price, the future sales price, which won't change at this point unless we have, change orders with the contractors. But at this point, that is my final sales price. And just add it and obligate it, as disposition cost.
Yeah, it may be possible, but why don't you put it into a question, into the Ask a Question feature, so that we can be sure.
And Tatiana, one of your colleagues emailed in a good point, which is, so are you talking about you guys paying the closing costs on behalf of the home buyer, you the county or the city, or are you talking about the seller's closing cost?
No, the buyers.
Okay, I think that, the person who wrote it is probably right. I think that's where the confusion came up. I believe that, because I was on the call on Thursday, and I wasn't the one who answered the question, but I believe that what they were talking about on Thursday, when we were all talking about this, was the closing cost for the seller, who, when you're, so it's not for the buyer, it's not for Mrs. Smith, but rather it's the closing cost when you guys, the city or the county or whomever owns the property, are going to have to record your half of the closing cost?
No, I don't. No, when I presented the question, I just presented it like exactly like I told you today. And my main concern was how to obligate them, because at this point we do not have buyers for those properties.
For the buyer's side of the cost.
Exactly, from the buyer's side. So, and that was their answer.
Yeah, so Tatiana, if you could do us a favor, and I can also send you the link. If you can send it in to us under the Ask a Question, we'll get you an official answer so you have something in writing.
Okay, perfect.
Yeah.
Thank you.
Yeah, and I'm glad you made that you differentiated between the seller's closing costs, the buyer's closing costs, because maybe we should do a Q&A on that.
And we should thank Jesse. One of our listeners brought that question up, so thank you, Jesse.
All right, thanks.
Okay.
Thank you. All right, so let's next person on the call.
And next we have John Carter with City of Taylor, Michigan.
Hi, John.
Hi, thanks for taking another question from us. We can ask you questions all day. The eligible use E that you made mention of earlier, is that restricted to just target areas?
It is. It's the same NSP rule as everything else. It has.
I mean, all of your money is restricted to target areas.
Okay. What about when all of the goals are achieved and there are still program income? Is that still restricted to just target areas?
Yes. Remember, so you're going to want to amend your plan to the extent that the target areas are changing.
Okay.
Right? Because the economic conditions in each of these areas are constantly changing.
Yes.
Right.
Which we are in the middle of doing that now.
Right. Right. So to the extent that you need to move the money to a different area of greatest need, or maybe the area where they were targeted before has now been stabilized, right? Then you would just want to amend your plan to do that.
We had a property that we purchased under it's adjacent to one of our parks. So we purchased it under the assumption we were going to purchase and demo. During the public comment period, we had a couple comments about utilizing that for a war museum. Would it be
war museum?
Yes, which we currently have a small war museum in City Hall.
The question is, well, okay, so under eligible use E, a museum could be a public facility, but your problem is going to be how are you going to meet the national objective?
Right.
Because if you think about the national objective for a museum, it's usually not the adjacent neighborhood where the museum is located, but in many cases,
the city at large,
the city, the state, the county. I mean, and sometimes if it's a big museum, even bigger than that.
Yeah.
So it's very difficult to meet the national objective on a museum.
Is that the question?
I'm sorry?
So who is it serving? Is that the question?
Yeah.
Right.
Who might come visit the museum?
Okay. It would actually be on the park property.
So you'd have to look at how big the reach of the museum is. You know, is it for example, there are some museums that are very small that might just draw from the immediate town. Let's say like a historical exhibit for the town or something. But a big museum, or one that for example, the town I'm from in Montana has a Lewis and Clark Museum that draws people from all over the country. So technically, in their case, it's the whole country. It's the service area. So you need to look at who the service area is for the museum.
Yeah.
Okay. Would that be to even hold it, like land bank it, or
to use NSP funds on it? Period.
Because it was already purchased with NSP funds under the assumption we were going to demo it.
Well, so you might have to reuse it for something else then instead of a museum. The other thing I would tell you about the museum is you would also have to make the case that the only way you can do public facilities under NSP is if they benefit that target area. So in other words, say the residents of that target area who are also getting foreclosure assistance or down payment or whatever else you're doing in the target area, the public facility has to be a part of those efforts and benefit them. So if a war museum is not something that the people of that neighborhood would typically partake of, and I'm not saying it isn't, but just to use the example, you may not be able to do it anyway. So you have to make a point of tying it to the other activities you're doing in that neighborhood.
Gotcha. Okay. Thank you very much.
Thanks. All right, our next caller, please.
We have no further questions in the phone queue at this time.
Okay, so it looks like let me make sure that we're closed out of on the.
And there are no written-in questions?
There does not. There's I think let me just make sure we covered everybody who has emailed in. Sherry Miles, if you still have a question, I don't think we've heard from you yet. If you're interested, please press *1 at this point. Or Darlene Rich, I don't know if we've covered your question or not.
Pardon the interruption. We do have a follow-up from John Carter with the City of Taylor, Michigan.
Okay, John?
One of mine. when establishing the financial mechanisms for using the LH-25 requirement, is the city charging interest?
What do you mean, interest on the loan?
You certainly, there's nothing that would prohibit you from charging interest. The issue is, are you making it affordable?
Right. Yeah, John, if you mean under a financing mechanism, if you're making a second mortgage or if you're making a first mortgage, could you charge interest on those? You absolutely can. You just need to decide whether that's what your program wants to do in terms of its design. Does that answer the question, John? Okay. Well, I see we have a number of purple dots that are lit up, but I don't think we've gotten to your question yet. So let me start. Has Tricia called in? Tricia Pollard?
Yes, we have the line of Tricia Pollard. Your line is open.
Okay, Tricia?
Thank you. Hi, everyone. Thank you for taking my question again. I've been on a number of times talking about the same issue, which is
I was just responding to your email, but I didn't finish before this call started.
Okay, because I heard you earlier, David, and I wondered if you had had a chance to look at our email when you made those comments.
So, Tricia, why don't you recap your question so folks on the phone can
because there were 4 of them. There were 4 scenarios you gave me.
Yeah.
Okay.
Our issue was that we felt as though the financing mechanisms we had set up to pay for purchase buy down was in fact an expenditure, and David has talked about the fact that the HUD is considering it to be just use of program income that you do not get back. If you purchase a home for $50,000 and you rehab it for $50,000, and then you want to put $20,000 in purchase assistance, HUD and David's point was that you just don't get that back as program income. Our point was
you'll just receive $20,000 less.
Right, you'll receive $20,000 less. Our point was that we were. We put it under financing mechanisms. We fully expected to issue a check for that $20,000 to the title company on behalf of the buyer, and that it was, certainly going to be rolled in with closing costs and, all the rest of the things on behalf of the buyer. But it was the buyer's money, and it is, in fact, an expenditure where we are expending out $120,000 and getting back $100,000 and a piece of paper, which is the mortgage, that obligates the other $20,000 that we put into the deal. But I know that David had answered that earlier with the same.
I think that was your scenario 3, right?
That was 4.
Oh, I didn't get to 4. Okay.
Number 4 was the one that you've been talking about.
Okay.
And we put in there, I have 2 lenders that work for me, former lenders, recovering lenders. And they were the ones that really worked on this whole financing mechanisms, and they felt very strongly, obviously, that it is an expenditure and should be allowed to be counted as such, especially in light of the 18-month looming deadline.
Right. The question was, or the issue is, since it's your property, right? If you own the property, right, then you dictate the terms at which it is sold.
Right, and we certainly understand what your point is, that you can receive back less program income.
Right.
But our point is that it is still an expenditure. Mm-hmm. Even if it's coming from program income, it's an expenditure.
Right.
That's our
So the issue with the obligations is obligations are considered, dollars that you are spending, right? And if you're not spending additional dollars, then how are you having additional obligations?
But and again, I guess this is why you asked me to put this in an email.
Yeah.
Because it goes on for so long. But But we believe we are expending additional dollars. We expend $120,000. We get $100,000 back for the cost of the repair and the purchase, and we get a piece of paper that's a mortgage back for the additional $20,000 that we have put in it.
In this case, no. What you'd be getting back is $80,000 and a piece of paper for the $20,000 mortgage.
Right. Right, if you're under scenario 4. If you use program income, then you're getting back $80,000 and a piece of paper that obligates you for the other 20 under the mortgage.
Right.
Correct. But it's still an expenditure.
Yeah.
You see what
I'm sorry, Paul Webster's not on the phone to walk you through it, but it has something to do with proper utilization of the Treasury's money.
Right. Well, if you could read, I know you said that you hadn't made it to number 4 yet, so.
Yeah. No. I'll send this one out to you.
Okay.
As soon as the call's over.
Okay. All right. Well, and if you could, if you could read that and share it with Mr. Webster, maybe it's a different way of looking at it. I think we truly believe that having a mortgage and securing it with the $20,000, whether it's an actual check or it's program income, is an expenditure. So. Right. And the lenders have gone through the whole scenario for you in that scenario number 4.
Right.
So, Cliff, this topic has been a big area of question over the last couple of weeks, and so I believe we've talked about there's a need for extra FAQs or perhaps guidance on this issue. So I would watch for either of those, either an FAQ or policy guidance coming out to help try to solidify this. So if folks have examples or questions about it, do feel free to put it into the Ask a Question so that we can get it into the common knowledge for everybody.
Okay. Thank you.
Thanks. All right, Tatiana, I see that your dot is on. Do you have a question? Or David, do we have anybody in the queue?
Yes, we have Rich Malloy with Oregon Housing and Community Service.
Okay, great.
Good afternoon. Got a simple question. We have a project in Southern Oregon where a housing authority can acquire land and build 60 units. However, they will do it with tax credits and will not build the units till probably after March of 2013. Can we count those units as part of our contractual obligation, our minimum unit count for our grant agreement? I know we can't count it for the set-aside until the units are occupied, but can we count it as the unit count?
You mean in terms of being obligated for NSP?
Yeah, we'll actually buy the land this summer, get the deal done. So in terms of the number of units that we put into DRGR, the state is supposed to get to 318. Can we count these 60 units as part of
why is the state supposed to get to a particular number?
Well, it's under our grant contract, unless I misunderstood this, under our grant contract, aren't we supposed to get to a certain unit count as we...
Oh, no.
Are you NSP 1 or NSP 2?
Oh, that's just an NSP 2 rule?
Well,
you mean the 100 units?
Yeah.
That's an NSP 2
that's
rule.
an NSP 2 rule.
So in NSP 1, theoretically, if we only did 10 units, it wouldn't matter.
Yeah, because it just depends on what, on how you structure them from a financial standpoint.
Okay.
So the money may not go as far in one area.
So theoretically, you don't care on NSP 1, so it's not.
Well, you care in the sense that you're going to report on your outcomes to the public, and you're going to tell Congress and HUD and everybody else how many units you created, and that's a good thing. But in terms of the timing of the units and like whether those units happen 2 years from now or now or whatever, none of that matters for NSP 1. What matters is that by September you've got the money under obligation, and so if you've got a contract with this developer, or did you say with the housing authority or whoever it is, the county, who's doing? You said it's the county?
It's a housing authority. If we put an agreement out there, they could acquire this land this summer, and we'd actually have it spent by September.
Okay.
The bigger issue, and so I heard your webinar the other day, and you said that in terms of counting it as the 25% set aside, we could not do that until we had units that are occupied by people.
Right.
Well,
until they're serving.
Guys, not necessarily true.
Really?
No, if you have got a contract with a developer or with a construction contractor or with a subrecipient, and that contract says thou shalt only rent these units for low-income people, and for very low-income people, then you can count that at the obligation phase as obligated.
There is no obligation phase in NSP 2.
He's in NSP 1, though. He's in NSP 1.
Oh, you're going back and forth.
Yeah, he's NSP 1. So you can count that as obligated for LH 25 because you've set it aside for people who are low income, even though the units don't exist yet. But what David said earlier in this call and said I think last week as well is that's good and you need to do it and it's important and we're not downplaying that at all. But what's really important is come 2013 that you could show that you promised that you were going to set aside these 100 units, let's say, for low income. That's how you obligated it for LH 25. That what's really important is at the end of the day when they come to monitor you in 2013 that you can show that you actually spent the money and they're occupied by people at 0 to 50.
They are serving that target population.
Yeah, and the project probably won't be built or occupied until maybe 2014 is the problem.
Okay, well, that is a problem then, because when you get to 2013 and you've spent all the NSP money, which you will have done by 2013, you have to have met the 25%.
Yeah. Right. Okay. Clarified. I'm good. Thanks.
Okay.
All right.
All right. Anybody else in the queue, David?
Yes. We'll go next to Katie Rademacher with Hamilton County, Ohio.
Hi. Can you hear me?
Hi, Katie.
Hi, Katie.
Hi. I have a question about developers' fees and realtors' fees when it comes to obligating. We've got a situation where we're running out of some money, and the way we have it set up with the developer's fee, that the developer's fee isn't paid until after the property sells. So do we have to include, and the same as the realtor fee, the 6% realtor fee isn't going to be paid until the property sells. So can we not include those two expenses in our total obligation and do it out of program income the same as the soft second mortgage and just reduce the program income so that the number that is obligated is less?
the fact, okay.
I know it's part of the total project cost, those two things are. But
No. It's part of the total project cost, but it's not part of the principal, right? Let's not mix up homeownership assistance from other fees that are associated with the sale of a home. Okay, realtor fees, title fees, developer fees. That is separate from homeownership assistance.
Oh, I understand that. It's just a matter of whether we can.
So the fact that you have a contract with a realtor and it specifies that the realtor will receive 6% of whatever the sales price is, then you have an obligation. And the same goes with the developer.
Okay. Yeah. The developer, our contract says that they get 10% of the total development cost, and then they get that 10% once the property sells.
Yeah, so they don't have to have received it already.
Yeah, you've got a contract with that developer that says, okay, total development cost is going to be $500,000, just to make up a number. Of that $500,000, maybe $40,000 is going for the roof and $50,000 is going for the sidewalk or something. The developer fee is just another line item in that total development cost, and so it can be obligated in the same way as everything else in the contract with the developer can be.
Yeah, okay. This kind of question it's kind of weird because I know that most people would want to obligate it. I guess I'm saying one of our communities is running low on money, and if they obligate the developer's fee up front in DRGR like you normally would, they would not have enough money in their allocation to do that. But if they don't include that 10% in there, then the numbers work. Because the money is being paid after the property sells, so I'm wondering if we can take the developer's fee out of the program income and not.
Yeah.
Really, I don't see. Yeah. I mean, like we have a bar.
You couldn't do that.
Yeah, we have a bar that's set for what we consider an obligation. But if you're saying you
don't want to obligate it because we don't have the money to
delay the obligation, then I don't see anything wrong with that.
Okay.
Yeah.
I know it's a weird thing, and we're not. It's just a couple communities where they're running out of money and they want to. So yeah, okay. Another question I have is about demolition and an eligible end use.
And one other thing I'll add is just be, no matter how you structure the contract, whether the developer gets paid now or later, right? The obligation is just a contract saying they're going to get paid at some point.
Yeah.
It doesn't mean that you have to come up with the cash right now.
Yeah. Okay. I understand that.
Okay.
All right. Thanks. The next question I have is about demolition and one of the eligible end uses where you donate or sell the lot to an adjacent LMMI homeowner. I'm trying to figure out, we're going to do that in a couple of situations, and I'm trying to figure out the best way to sort of structure that, whether, we should donate it or we should sell it, and if we donate it, are there any restrictions on that home buyer or on that adjacent homeowner on their use of the lot? I know that there's not an affordability period if you donate it, because I asked a question once about that, and I was told that there's no affordability period because there's really no money involved because you're donating it to them.
Well, that's not the reason there's no affordability period. I think the reason there's because you can have affordability period when you donate something to, like, let's say if you're a home buyer situation and I donate the house to, to a dollar home or something, I would still have an affordability period for my NSP investment. I guess the question I would ask, and the reason David, you guys probably ought to rule on this, but
it's probably a resale. You use a resale provision.
Or what I was going to say in this instance is because it's demolition and there really isn't any home buyer assistance happening.
No.
That maybe that's the reason there wouldn't be a.
And maybe that's what John Laswick was meaning when he said that there would be no affordability period, is because there is no home buyer assistance. It's just donating them this lot where the house was demolished.
Right.
So I guess if we do donate it to them and there is no affordability period, I just want to make sure that whoever we donate it to doesn't turn around and sell it. Well, we're going through our income process that we use for home buyers that actually go into rehab houses. But I just want to make sure that they aren't going to sell it.
So you could use a resale provision,
okay,
right, which ties, like, let's say you donated it to them, but you've valued the property at, I don't know, $20,000 or something, the land that you donated to them. So you could tie a 20,000 would put you at what?
Put something in their deed.
Right. Excuse me?
Put something in their deed.
Right. Saying that they have to, if they sell within this period of time, they have to sell to some income-eligible home buyer. There'd be nothing wrong with doing that, And that's what I see happening a lot with the dollar homes that are being sold, because while the total development costs are not significant, the home buyer wouldn't have had access to that property had it not been for NSP.
Yeah.
So
I guess I just can't see requiring the person to sell their house, which we didn't have any part of, to another income-eligible buyer because we gave them a side yard.
Right, but I guess you could make the argument that their property is more valuable now that it has a larger lot.
Oh, yeah, definitely. Yeah. I definitely agree with that. Are there any other ways to structure it other than doing a resale? Could we just
well, there's nothing to recapture if you didn't give them any money.
No.
Right. So the cleaner way is to sell it to them. But if you just want to donate it, then it probably wouldn't be a big issue. The question I usually see that comes up is, do I have to verify their income? And the answer to that is yes.
Yeah. I knew that for sure.
Okay.
I think the question really is, have you triggered the resale recapture requirements at all? And it sounds like from what John answered to you that because there is no home buyer assistance, you haven't really triggered that requirement.
Recapture, no.
Or resale, for that matter.
Yeah.
And so we probably ought to verify that, David, just to make sure and get it out to everybody to reconfirm that. But assuming that that's true, because there is no direct home buyer assistance in this instance, then I think whatever kind of land covenant or deed restriction or contractual requirement you want to have with that home buyer would be completely your decision. You wouldn't have to follow resale. Assuming we hadn't triggered it, assuming that's the right answer, you could decide. So you could have a contract.
That's what I was kind of wanting to do. I was kind of wanting to say, have them, whether it's in the deed or something where it says that they can't sell the lot to someone else to build a house on it and make
or they have to use it for
money off of
residential
it.
purposes or something like that.
Yeah, for like maybe
that could be part of your resale provisions.
So I think David, the question we have to answer and we have to reconfirm for everybody is, and we should get this into the FAQs, is whether or not when you're donating, because you put the money in the demo, but you haven't you haven't done anything on the home buyer assistance at all.
Right.
Whether you trigger resale recapture. If you don't trigger it, then it's completely a local decision, and you guys can put anything in your contract you feel like it.
Okay.
Yeah, we should probably run that by the home folks.
If you would, that would be great, because I know we're going to do this in a few situations, and I just wanted to make sure that we are doing it correctly.
Sure.
Yeah, I'll get it into the FAQs, and we'll try to get an answer out to everybody.
Great. All right, that's all the questions I have.
Thank you. We have a couple of purple dots still open, so who's our next caller?
Our next caller is Sherry Miles with DHCD in Virginia.
Hi, Sherry.
Hi, how are you?
Good.
I have hopefully a very simple question. Can we consider rehab funds obligated if the home has been identified, so there's a ratified sales contract between the grantee and the REO asset manager, but the acquisition is not going to close by 9/17. So what we're trying to do is, could we write a rehab contract to be signed with the contractor contingent on, one, the house closing, and two, not to exceed our rehab cap?
Oh, sure. As long as you have a contract with the contractor, that's fine. You've made a commitment. They will get paid for 123 Main Street.
Right.
They're just not getting paid right now.
They're not getting paid right now. And it can have that contingency in it because, if for some horrible reason the property fell out, we can write that contingency in there.
Yeah, because contingent purchase agreements are acceptable as obligations. So.
Thank you.
Yeah.
You have made my afternoon.
That's what we're here for. All right, our next caller, please.
We'll go to Glendora Merchant with City of Deerfield Beach.
Glendora? You still there?
Can you hear me?
Yep, you had us muted for a minute
Oh,
there.
sorry. Yeah, I
okay.
keep hitting the mute on and off. I'm sorry. I'm back. Okay. I had another question here, and I'm trying to find out regarding construction contingencies, and this is the cost of rehab.
Mm-hmm.
We have a rehab program outside of NSP already in this office, and usually the memos that go to Commission for Approval includes a 10% contingency cost. This doesn't go out in the bid document to the contractor, but this is us covering us here in case there are change orders or they open a wall and there's more work needed to be done and we didn't have enough money allocated for that rehab. Mm-hmm. Can we obligate that 10% contingency as part of the acquisition rehab?
The 10?
Yeah. For instance, if the contractor bid, the lowest, most responsible bid came in at $50,000.
Right.
And we want to put in a 10% contingency for change orders and any unexpected costs.
Are you going to put that 10% contingency in the contract with the construction contractor?
No, that's not how the bid document is written.
So it's outside the contract?
It's outside. This is what we send to Commission for approval.
I don't think so, David.
Yeah, because you're not committing it to anyone. You're just building in some cushion for yourself.
So if you put it, what you could do is you could allow it, now I'm not sure you should do this, but you could, if it were part of the construction cost estimate, and therefore became part of the construction contract, then possibly it would be okay, although obviously you'd have to monitor the use of that contingency. You couldn't just let them do whatever they felt like with it.
Yeah, because we don't give them, the cost estimate that we get from our scope of work. We let them give us their
right.
But I imagine, though, can we maybe write the contract in a way that we build in that 10% but don't let them use it, just put it in, word it in a way that it's not used unless they're, legitimate change orders?
That makes sense. I think you should run this past Paul, but what I would say is if it's in the construction contract between the grantee and the contractor or the grantee and the developer, whomever, and it's part of that detailed cost estimate that there's a 10% contingency, and you guys put a process in place that says you may not tap this unless you have a change order that we've approved, blah, blah, blah.
Right, because all change orders have to go through Commission here anyway, so it's not like they could just, use it as they feel.
Yeah, I would think that would be okay, but the issue is that you may, if if you never use it, if you never use that 10%, you would have to net it out. It would be an unliquidated obligation.
Right.
That you would have to net out.
You'd have to de-obligate it. Yeah.
Right.
Right, but if we come in and we're coming over, then where would we get the extra money from?
Right.
Well, you have to take your extra money from your grant or from your program income or something. I think we should run this past Paul,
sure.
David, but I think generally the answer, because construction contingencies is a fairly common line item in construction work write-ups. So let us verify for you, for sure, with the folks, for the finance folks at headquarters. But what do you think, David?
It certainly sounds doable, because it could be included as a line item expense. But I'd want to run it by Paul too to make sure.
So we'll put it into the FAQs and get it out to everybody.
Okay. And when can I look for that?
What do you think, David?
Let me check with him tomorrow, and I'll get a Q&A. Can you send it in the form?
Can I send it to ask a question?
Yeah, if you send it to ask a question, then I can get it up fast.
Oh, okay.
Yeah.
All right.
It goes to the official channels that way, so that's helpful.
Thank you, and I love this Q&A.
Oh, good.
All the webinars, yes.
Glad to help.
Thank you.
Okay, our next caller, please. We only have about 10 minutes left to go, so our next caller, please.
Jennifer Olson with State of Montana.
Hi, Jennifer, again.
Hi there, I'm back again. I just have actually a question about meeting our 25% in regards to occupancy by 2013. And I guess what we've been doing here in Montana is we have been letting the subgrantee decide whether they're going to use a recapture or a resale provision. That's their choice. But in all actuality, my question is, what if the first home buyer who is 25, who is 50% or AMI or below, so meets the 25% set aside, resells or sells their house a second time during that time period, and they, for instance, decide that that grantee is saying, well, we're going to do a recapture provision, not a resale, so they don't have to sell it to somebody who's 50% AMI. They only have to resell it to any eligible home buyer, and then they would just recapture the investment that they originally put into the property, the first initial investment. How would HUD be looking at that? Should the state be pushing grantees towards resale, or if that resale happens, that second resale happens, and they're not part of that 25%, will that not be counted?
Well, Marcia, you could probably answer this better from a home perspective, because that's where the rule comes from.
Right.
The resale recapture isn't done on a home by home basis, right? It's done on a program basis, no?
No, what the state is allowed to do is to let people, the state can let its state recipients decide. So you could have Billings and Bozeman could each have different.
But once they choose one, they can't flip-flop.
Right. So you can't just mix and match with individuals. Whatever you guys have set up for that program. But there's a bigger question here, guys. So let's talk about the answer differs for whether it's resale or recapture. So let's start with recapture. If you're doing recapture and you get money back in, they're going to sell the house, and really, this doesn't have anything to do with the 4-year expenditure time frame, the 2013. This actually has to do with the affordability period. So the answer is, if you're doing recapture, and sometime during the affordability period, whether it's 5, 10, 15 years, whatever it is, they're going to go sell the house. And they originally counted toward the LH25 because the original owner was a very low-income person. When the program income comes back in from that recapture activity, it's just regular program income. It no longer retains its 25% taint.
Right.
You just use it as
the 25% set aside is a one-and-done rule.
It's done, right. So you're all set. You're all done for recapture. So the money comes back in as program income. You have to spend it on eligible activities like any other program income. Now, put that aside for recapture. Let's talk about resale. Resale is a different ballgame. If you're under resale, and again, you had the 5, 10, 15, 20-year affordability period, and what you're doing under a resale provision is you're saying, I'm going to sell it again to another eligible home buyer. What HUD has said, and David, you can verify this, is that if you originally counted that unit for a resale provision against the LH25, so the original owner was 0 to 50, then when they go to resell it, the next eligible home buyer also has to be 0 to 50. Right. So that for resale, again, not recapture, but for resale, you've sort of called that unit, you've sort of put a stamp on that unit, and you've said that unit is a very low-income unit. Therefore, it has to be resold to another very low-income person.
For that affordability period.
For the affordability period.
Right. So you have to finish out that initial affordability period. You don't start a new clock.
Sure. Well, and that's what I'm thinking is that, and I guess that's what my thought was, is that if we have a resale, all of the requirements, I guess it's recapture is identified not to the house, but to the individual, to the money.
The money,
and
right.
Is identified to the house.
So the money loses its taint, because as David said, the money only has a one circulation issue. It's the first money it's the house. If you do it under recapture, or under resale, that's the problem, that you have to continue to resell it during the affordability period to 50% of income people. Exactly. And so that I can see why we would want to make sure that that's counted correctly, or that resale occurs correctly. But for recapture, and let's say the city of Great Falls is allowing for recapture. What I've been saying is that period of affordability is really tied to the dollar. So basically, if we sell the first house and it goes to an LH25 family, and so that family resells it a second time, we don't really care who they sell it to. It's that dollar that I care about, because then that dollar has to turn around and be used for that same eligible purpose, and for the same. It would then start again with the period of affordability of 20 years, wouldn't it, or would it not? It would. So when the cash comes back in under the recapture provision, it's going to come in as program income. So it's no different than any other program income. It doesn't have the LH25 taint to it anymore. It's just plain old NSP program income. And so when you go out and re-lend it to the next home buyer, or build the next unit, or do whatever you're going to do with it, then that new unit that you're subsidizing has a new clock, right? Yep. And so would HUD count the recapture, that first unit being sold? Let's say they sell it within that 4 year, before 2013. We could count that unit as a 25%, and then those dollars coming back as program income could be actually put as a financing mechanism, basically for somebody who's 120, but we would still get the credit for that initial sale.
Yes.
Again, for the initial one, because the initial you're going to count it for the first occupant of that first unit.
Right.
When the program income comes back, you're no longer worried about LH25.
Right.
Exactly. Okay. And then I have a second question, and this is in regards to demolition activities. We have been counting our demolition activities that are related to the acquisition of a blighted foreclosed structure. And actually, we have one in Montana where specifically it was blighted. We have demolished it, and we're putting a new construction on it, and it's going to be sold towards for LH25 family. We're counting all of that total development cost towards our 25%. Is that correct?
It depends. Was the land originally foreclosed or abandoned?
Yes.
Okay. So as long as the land was originally foreclosed or abandoned, so that you get that tag on the project, right? That it's a foreclosed or abandoned.
And it was residential land?
It was, yeah. It's just a residential unit, actually owned, obviously owned by a bank now, and it's in horrible shape. So the rehab costs exceed the amount just to demo and newly construct them.
So you acquired it, you demolished it, now you're going to build.
Yep.
Yeah, you can count all of that cost towards the LH25 as long as it was originally foreclosed or abandoned residential.
Yeah, I just wanted to make sure that I was able to, even though demolition occurs under eligible use D, that it's still tied to eligible use B as where we started out in regards to.
Yeah, you can mix and match the eligible uses as needed. That's not an issue.
Perfect.
Yeah. The keys to meeting that 25% set aside is just that it's abandoned or foreclosed and applies to either a home or residential property.
Yep, perfect. All right, well, that's it for today.
Thank you. All right, I think we have time for maybe one more question. Was our last questioner, David?
Our last question comes from Adam Iliazon with Civic Stone.
Adam?
Hi. Are you there?
Hi, Adam.
Hi. Hey, this is a clarification on the question where the person asked about donating the land and the covenant. We have a similar situation in California with two cities. I'm a consultant, and where the buyers, after the developer fixes up the house, they get a subsidy to help them make the numbers work. after that period of time that they go to sell the home, there's home buyer assistance available using NSP funds, but we're getting quite a few buyers who are saying, I don't want any home buyer assistance. I can buy this property on my own.
So all you're doing is earning the land to them.
So they're income qualified. We make sure of that, but they don't want any home buyer assistance. And so now we're being challenged by this covenant that we have on the property because they're saying, why do I need a covenant on this property?
Because they wouldn't have gotten the sweetheart deal on that property had they not come through NSP.
But it does come back to the question that we have to ask John David, which is whether or not simply donating, you've bought it, you've demolished, and now you have vacant land, whether donating that land constitutes sufficient home buyer assistance that in fact it triggers resale recapture. And I think that question is outstanding. We need to get an answer to that question.
Before we were talking about side lots, though. This isn't a side lot. This is
not.
Yeah, this is land that's being used to build a home, right? So no land, no home.
It's actually a foreclosed home that was acquired, fixed up, and now is being sold to a home buyer.
Well, then you definitely have resale recapture.
Oh yeah.
There's no question about it.
Yeah, and what's ending up happening is the price of the home after the cost and everything is being worked out to be the same price as, in many cases, market value of homes surrounding it.
Well, that's not good. And you're not doing any other cash, right? There's no other assistance to the home buyer?
No.
Here's the issue. If you don't give any what's called direct home buyer assistance, whether it's a market write-down, selling it below market and taking back a second or something, or whether you give down payment or closing cost or soft second or whatever you might do, if you don't do any of that, then you're forced into a resale situation.
Yeah.
And so you're
going to make it that much harder for yourself to sell it.
Yeah, so you're going to have to impose a resale restriction, land covenant, deed restriction, whatever, on that site for the value of the NSP investment. So if the value of the NSP investment was $50,000, that dictates a 15-year affordability period. I don't have a 15-year land covenant. Because you're not giving any direct home buyer assistance, you don't have the choice of choosing recapture. You have nothing to recapture.
Yeah.
Right. Well, that's where we're prepared to do right now. We just have this issue coming up where most recently, because we're selling the properties, we're seeing them sell now, and this question of I don't want any home buyer assistance, and now they're saying, gosh, why am I getting this 15-year covenant on the property?
Yeah. It's the nature of having established the program this way. If you could convince people to take $1,000 or $2,000 of a down payment assistance, then you'd have the option of choosing recapture, and then you could have a much shorter, you could have a 5-year affordability period, let's say. So the issue that you're having here is because you don't have any direct home buyer assistance, you're forced to do resale, and because you're forced to do resale, depending on how much money you're putting in the deal, you may very well have a 15-year affordability period that they have to comply with. And they can't, if they want these units, there's no way around it.
Well, and so the follow-up, I guess, is that if they don't get any home buyer assistance and the house had a subsidy to help make the numbers work on the acquisition, the rehab, and everything of $50,000, like you mentioned.
And that $50,000 was funded with NSP?
Yes.
Yeah. Then that's the investment. Well, but
well, that's the investment, David.
Yeah, but it's not recapture.
No, but it's resale. So
it's resale.
So on resale, what you would do
is based on $50,000.
It's based on the $50,000.
Yeah.
But now the flip of that is if we give them $5,000 to help them with closing costs, are we then using the
what number are you using, 5,000 or 50,000?
Then you're using the 5. So if you're going to do it under recapture, so let's say you gave them $5,000 down. The minute you do that, you've now allowed yourself the option of recapture because you have something they owe you. You have an amount subject to recapture.
Okay.
And so what you could do, if you could get them to take down payment or closing costs or whatever kind of assistance, then that $5,000 that you gave them is the direct home buyer assistance. And you could say, okay, then the affordability period, again, for recapture is based upon that $5,000. And so it's 5 years instead of 15.
Got it.
You can't get out of it entirely, but you can change it depending on whether you choose resale or recapture. Yeah. So this is all driven by whether you go the resale route or the recapture route.
Right. And if I don't, and again, if I don't do any home buyer assistance, it's resale tied to the amount to the property.
To the amount of the
total
subsidy.
investment. Yeah, the total NSP subsidy.
Yeah.
Okay, gotcha.
Yeah. So again, unfortunately, it's just the way that the resale recapture rules work, and the home buyer, as David said, is getting a home that's been renovated, that's the acquisition assistance to help make it standard, and all those things that they wouldn't have but for NSP.
Right. Okay.
All right. Okay.
Okay. Thank you.
Marcia, I have to run.
Yep.
But I'll call you at your number.
Okay. So thanks. So let me close out with everybody. Thank you very much for joining us, and I hope that you guys have found these sessions to be helpful. Let me turn on to the link, and we will email this out to everybody as well, but we'd like to hear your feedback on whether these sessions were helpful to you or not. So please email us and let us know what you think about them, and give us any suggestions for any additional sessions that you'd like to have. And again, we'll email this link out to you as well, and let us know your thoughts. Also, if you do have any questions, if we didn't get to you, we had some folks in the inbox who didn't get their questions answered, please go